We had this, very optimistic risk-on moves in January, February. I think the story is really about sort of macroeconomic reality becoming, priced back into the market. I think similar to the note you were just discussing, 18 times forward earnings does look very rich if you do expect some turbulence ahead. Now, I think, a recession is not a foregone conclusion.
Right.
And that's why I think we're holding at these valuations right now.
You use the word macro. I felt like a few weeks ago, people had started to flip to this idea that we finally got into this micro market. And a lot of that, of course, seemed to be predicated on this idea that the Fed was near the end of its hiking cycle here. You think that for the next few months, maybe even the next year, that macro is basically going to be the main driver?
Well, I wouldn't say for the full year, but I definitely think, what we have come to realize in the last couple weeks as those inflation expectations have looked a little bit hotter, as Fed fund rate terminal rates have moved quite a bit higher. We had sort of a period of sort of status quo around, a consensus around 5%. That's pushed much higher now. So certainly macro is still I'd say in the driver's seat. But I think what we need to pay attention to is what we are seeing on the micro, right? I think probably this market is overlooking some of the information that did come through in the earnings season. And the earnings season I would describe as pretty underwhelming. Corporations were guiding lower. And really the big takeaway is the speed with which we've seen downward revisions looks a lot like heading into a recession. So I think you need to be preparing in terms of your asset allocation, preparing for more market turbulence.
Well, let's talk about how you actually factor that into asset allocation, the information that you're getting into the micro. How should that inform where you're allocating your money right now?
Well, let's start at the high level, even though we're talking about micro. The high level is that we still think bonds look better than equities right now. As I said, 18 times looks pretty expensive given what we think earnings are headed, what Romain alluded to, typically what we see in terms of multiples when we do go through recessions. Now, again, not a foregone conclusion, but if you're thinking about what has the best downside protection in this type of market, it's not equities. Bonds look much more attractive. We've spoken before just about, it's about total returns this year. I know earlier programs today, it was sort of being thrown out there, this was supposed to be the year of the bonds. Is it going to be? Can we throw that out the window? I think it is still going to be the year of the bonds. We just have to be a bit more patient.